Well, the economy is clearly slowing. If you look at retail sales data, if you look at housing data, if you look at the conditions that lead to a weakening economy, like an inverted yield curve, we've got the deepest inversion. We had the deepest inversion, or one of the deepest versions ever, and the longest inversion on record. Financial conditions are still easy, though. We still have credit spreads that are quiescent, and yet we see some cracks in the labor market. So it's early. It's a long time. I remember that. So go back before I got thrown off CNBC. It was 2008. They were asking me, well, you've been saying this for about a year now, that the housing market was going to be in a crisis, and the Fed raised rates to 5.25% back then, 2006. A year later, the market topped out in the summer or fall of 2007. That's when the S&P topped out. And then a year after that, the entire economy, financial market globally fell apart. Well, the Fed stopped raising rates last summer at 5.25%. And there are lag effects. I wouldn't be surprised if the market topped out and we see credit card, auto loans spiking, defaults spiking, delinquency spiking. You see problems in the banking system. Commercial real estate is a huge problem. Maybe that's the subprime 2.0. But there's three bubbles that we have that exist concurrently. We've never had three bubbles before exist at the same time. We have a real estate bubble, a massive real estate bubble. We have an equity bubble, and we have a credit bubble. Before we had, in the year 2000, we had a NASDAQ bubble. It was just a bubble, not even a bubble in the equity market broadly. It was really a bubble in the NASDAQ. But that didn't stop the S&P from going down 50%. In 2008, we had a housing market bubble. The equity bubble really wasn't that acute back then. But again, the S&P still went down 50%. But now, as I said, we have a credit bubble, bond bubble, equity bubble, and real estate bubble. Massive, unprecedented, all existing concurrently. And that's because we had 10 of the 14 years after the global financial crisis, we had interest rates that were near 0%, so less than 1% for 10, a whole decade. That created massive distortions in the market. What do you do when money is virtually free? You borrow it, right, Danny? And the government is insolvent now. We have a record amount of corporate debt as a percentage of GDP. Collateralized loan obligations, that number is through the roof. Private credit is in real trouble. Commercial real estate, mortgage-backed securities. We got major problems all over the place. And the only thing that's holding it together, I believe, is the amount of liquidity that was pumped into the system ex post the COVID crisis. With the reverse repo facility, which really is a parking place for banks' excess reserves, hit 2.5 trillion. It went down to 2.2 trillion. It was a spike to 2.5, but really was 2.2. A year ago, it was $2.2 trillion of excess reserves. That money has poured out of the reverse repo facility. So think about it as reserves parked out of the financial system at the Fed, laying fallow, doing nothing but earning, interest, credit, getting credit. Then came out of the reverse repo facility, and the money market funds purchased bonds with that. And those bonds represented treasury bonds that were pouring money into the economy and used by Wall Street gamblers. You think like Roaring Kitty and, Nvidia going up the market cap of Berkshire Hathaway in just a few days, So this is what we have. We have a stock market bubble, and I give you one statistic. So total market cap of equities as a percentage of GDP is 195%. That is unheard of and unprecedented. It is several standard deviations outside of the norm. The normal ratio here is like 70-80% total market cap of equities to GDP. I'll give you one statistic. I'll give you another statistic. I'll give you a lot of them. So in 2007, it was 104% of GDP. In 2000, it was 140% of GDP. And before then, in the 80s and 90s, it was 70 or 80 for decades. It's just the total market cap of equities as a percentage of the economy should never be 190%. In fact, the top three companies, Apple, Microsoft, and Nvidia, top three microcap of equities, is more than a third of the entire U.S. GDP. Unheard of. Talk about a narrow rally, and narrow rallies never end well. Even before COVID, the COVID outbreak, January, February of 20, the repo market was crashing already. Money market rates were spiking, and there was a lack of liquidity for treasury purchases. So, why would Jerome Powell say, I am really, really anxious to start cutting interest rates? Because I think the inflation genie, or whatever they want to call it, the Fed is the monster. That's the inflation monster. The inflation genie is monetizing government debt. That's how you get inflation. You destroy the market's confidence in a fiat currency. That's inflation. You can get it by a lot of ways or several ways, but the best way to do it is just to monetize debt. And we did that with the helicopter money. $6 trillion of helicopter money rained down on people. ago, 4.5 trillion of it was monetized by the Fed. So that's where you get your inflation from. But inflation has already destroyed the middle class. The lower three quintiles are broke. They're out of stimulus. So the only thing keeping the market holding up is all this money pouring out of the reverse repo facility. There's only $300 billion, $380 billion left. Only, I say only in quotes, but that's down from 2.2. You've had about $1.7 trillion or so of QE in the past year. So that's what's holding the top two quintiles together. I mean, look, hey, I've got 5 houses. My real estate portfolio is doing great. My equity portfolio is doing wonderful. So I'll keep traveling to Europe. And that's what's making things look okay. But underneath the surface, most of the American middle class destroyed. Most of the stock market, by the way, has gone nowhere this year. The Russell 2000 is down negative on the year. The equal weight S&P 500 is up 4%. And that includes NVIDIA, by the way, just isn't overweighted. So most stocks are down. Most of the Americans have been wiped out. And that's when you poll people, they say we're in a recession and in a bear market. It's because they are. Because they don't, what retirement portfolio, what fiduciary, you come in, they shake your hand. How you doing? What's going on? Well, I'm preparing for college and my wife's here. And, what's your financial plan? I'm going to do 100% NVIDIA for you. Oh yeah, nobody does that. So people own stocks and bonds. Well, bonds are down 4% this year. If you look at the TLT, the long duration bond, they're down. They were down this year. They were down last year, down the year before, and down by a lot. So if your portfolio is 100% NVIDIA, you're doing fantastic. If it's a balanced portfolio with stocks and bonds, not so much. Once the labor market really begins to melt down, and we're already seeing that happen. If you look at initial jobless claims, the 4-week moving average is the highest in September of 2023. Continuing claims are up on the move too. Look at the household survey. I think we lost over 400,000 jobs last month. Lost 400,000 jobs. So there's a lot of evidence that shows that the labor market is cracking outside of the non-farm payroll reports establishment survey number, the death birth model, which shows, hey, 270,000 jobs, net new jobs were created in May. Part-time jobs, I think, is down. It's all part-time jobs and the birth death model. They started cutting in the summer of 2007 when they had that Bear Stearns real estate fund, hedge fund blew up. And then from that point on, from the summer of 2007 to the end of 2008, they went all the way down to 1%. So it was pretty aggressive, but it was too little, too late. This time around, the Fed is probably going to, I think the Fed will probably do the same thing. They'll probably cut around the margins once, maybe twice, depending on how bad the labor market gets, because they're labor market, Phillips curve economists at the Fed. And the labor market is if you look at the non-farm payroll report, which they all focus on, that's a lagging economic indicator, but they're all focused on it. So by definition, they're going to be late, as they always are. And they're going to be especially late this time because inflation is the big problem. If they aggressively, ex ante, started to cut rates right now, as Elizabeth Warren and crybabies on Wall Street are crying for, they did it right now, there's no guarantee that inflation would go down to 2%. I think it would most likely be guaranteed that it wouldn't go down. It would go up. The dollar would get crushed. Import prices would surge. Energy prices would rise. I don't know if the real estate market would really come down. So there's a chance interest rates would go up, especially long duration along the yield curve. But if they cut rates now, there's a chance that interest rates would go up, because if they cut rates now, the U.S. government, for the first time in forever, is insolvent by many, many metrics and many ways of looking at it. It's insolvent. $1 trillion in interest on deficits, $2 trillion deficits. The debt is 725% of our income. We're adding 42% every year to the deficit, 42% of our revenue to the deficit. Think about that. Think about going to the bank and saying, I want a loan. 700%, your debt outstanding is 725% of your income. And not that you're saving money every year, you're adding to your debt by 42% of your income. They would kick you out of the door laughing. But that's the situation we have. So $2 trillion deficits, $1 trillion in interest. So you start cutting rates in that construct, interest rates might go up. And then you also have the inflation problem. Like I said, I mean, the rate of inflation has come down. The rate of change has come down from 9% to 3.3%. But that's not 2. And it's going up from a level that's already, the price level has already bankrupted 3/5 of consumers. So the fact that it's still going up more slowly but above target shouldn't be a reason to cut interest rates aggressively, right? I mean, that's common sense. We'll probably have a very significant recession. because of the three triumvirate bubbles existing concurrently. And then the Fed's going to cut rates to ZERP, and then the Treasury and the Fed will be monetizing helicopter money once again, and probably is going to be a prescription for stagflation as far as the eye can see. That's what I think is going to happen.